Hey everybody, it's Swaminathan, April 21st, Tuesday morning around 6:30 a.m. Eastern Time. Wanted to do a video on the IBM trade. So IBM reported last night, it beat a little bit on the EPS, but fell short on the overall top line. So it's actually quite flat but yesterday it had a big day. It opened up, it went up about $5, $6. But here, as you can see today, this morning, the bid and ask is around 167. And so we have a double calendar, and I have a short straddle as well. I was short on time. I wasn't able to get the order going. So anyway, let's take a look at what the graph looks like. And this is what my graph looks like. Let me just see if there's any simulations here. Nope. So this is my real graph. So what is going to happen is there's going to be a volatility crush. So let's go take a look at the options and see what here. So this one is for almost 45% the front week. Then we have 31%. Then here we have 25%. And then you can see it normalizes around 2022. So let's say the way to simulate this, I think somebody was asking in the trading room yesterday. So the way to simulate this, I think all of these is going to fall to about 20% or 21%. So basically what we want to do to simulate this would be you come to the simulation window and if you look at this here, there is actually a uh, this more button. This is the key. So here, if you look at the more button, then that's what we want to simulate the individual options. Okay, so we want to simulate the individual options. So the April 4th, which is the weekly, which is right here, and that's at 45%, and if it falls to 20%, that means there is a drop of about 25%. So you want to adjust the volatility of the April 4 weekly to minus 25%. Okay, then what you want to do is the May 1 weekly, which is this one right here, that you want to also drop to about 20%. So that will drop by about 11%. So here, if we do this and say minus 11%, then what we have is the May 2. So May 2 is right here, and it drops from 28 to 20. So let's say about minus 8%. So this is how uh, you can simulate the individual options itself. And so once you do that, then what you have, if you look at the risk profile, then what you have is, if it opens, it's going to open very close to max profit. So what we are looking at is a profit of about, if you look at the number here, you're looking at a profit of about 1600. And then if you had the double calendar, you know that the margin was about 1500. So that's 100% return. So we would want to close this trade out at the open, meaning not right at 9:30 a.m., but perhaps wait for half an hour or 1 hour until all the volatility crush happens. But if IBM opens around 167, we're going to open very close to max profit, and so you would want to capture the 100% return, perhaps a little bit more on this, about 110% return. So that's that would be the plan for this morning. This obviously turned out to be a good trade, and so this is trade number 3 in our earnings cycle. The first one, Netflix, was 90%, and then we have American Express, which is still on, and so and we're going to right now it's still up by 265, and we are probably going to do the 30%. We just have to hold it for a week or so. And here the IBM is also another 100% trade if you look at this. So that's the plan for this morning. We would want to close out IBM because there's no I mean, once you're so close to max profit, there's really no advantage and only disadvantage if you keep it any further, because the trade's gone our way. Turned out to be a very good trade, so we want to close it this morning. Thanks.